I'd like to call this meeting to order. Right. So let's see, I think it's 1:30, and I'm calling this meeting the meeting of the GRF Finance Committee to order. And I just want to tell everyone, if you don't know, that we are on air. I mean, or we're being recorded. I don't think we're actually being broadcast. Is that okay? So yeah, we're not live. So if you would please speak into your microphone so people can hear you. And also, I have to remind you to put your lid on your cup and silence your cell phone, please. Okay, so the first thing is to acknowledge the media, and I don't see anyone. And then it's the agenda. I would note that we have put Blackrock Merrill Lynch presentation. It's been scheduled before the chair remarks and before member comments on the agenda. And I'd also like to be flexible and allow Beecher Carlson Insurance when they arrive to take them. So those are the modifications, and with those modifications, thank you. Do I have a second? I would second. I think we will vote since I made changes. So all in favor? If there's no discussion? Anyone opposed? Okay, we're unanimous. Let's see. Okay, so then it's a question, the notes of the prior meeting. Do I have a motion to approve the meeting report? The notes?
Motion approval.
Annette made a motion. Do I have a second? Is there any discussion? Okay. All in favor? Unanimous. Okay, so without further ado, allow me to introduce our first speakers, let's say. Okay, so there is Ed Bonapane. And he is Managing Director and Senior Portfolio Manager at Blackrock, and he's here with his associate, Craig Coleman. And Taryn Mull is here. She is the first VP and Wealth Management Advisor at Merrill Lynch. And I hand it off to you.
Thank you very much. The room looks beautiful, by the way. Really nice. I will spend just a few minutes reviewing the history of the accounts, the investment policies, and performance and fees, and then turn it over to Ed and to Craig to discuss the specific investment strategies, the security selection, and the market outlook. We usually have time for questions at the end, and so I would imagine today will be the same. This last April 2018 marked the 24-year anniversary of our investment partnership. In April of '93, a joint United, Third, and Golden Rain Finance Committee was formed to evaluate their concerns about declining interest rates and the resulting decline in interest income. And the committee agreed at the time that a portion of the reserves should be invested to increase the portfolio rate of return, that better returns in a bond portfolio might be accomplished by extending maturity, selling prior to maturity, and by purchasing institutionally rather than on a retail basis, and that a portion of the reserve should be professionally managed with a fiduciary taking responsibility for decisions and timing. And accounts were opened in April of 1994. Golden Rain terminated their account in March of 1995, but returned to Merrill Lynch with a portion of their reserves, approximately $1.2 million, in December of 2003. Interest was withdrawn monthly from each account until the spring of 2012, and the investment policy was amended to authorize the reinvestment of interest income instead of a monthly transfer. March of 2013, Golden Rain approved a resolution to amend their investment policy to allow for the purchase of up to 30% in corporate bonds rated single A through AAA, with no more than 3% of their portfolio to be invested in any one corporate issuer. And additionally, the amended investment policy allows for up to 25% of the portfolio to be invested in government-sponsored federal agencies, namely Fannie Mae, Freddie Mac, and Federal Home Loan Bank. May of 2014, the third board adopted an identical investment policy to Golden Rain, and in February of 2016, the United Board expanded their investment policy to include up to 20% of the portfolio to be invested or can be invested in corporate bonds rated single A through AAA, and no more than 3% of the portfolio to be invested in any one corporate issuer. United did not authorize the purchase of any government agency bonds. Your investment contract is with the investment manager, Blackrock. Fees are billed by and paid to Blackrock Investment Company, and the portfolio managers, Ed Bonapane and Craig Coleman, are employees of Blackrock. Your assets are held at Merrill Lynch, and accounts were opened in your local Merrill Lynch branch. And in January 2009, Bank of America officially acquired Merrill Lynch. However, the Merrill Lynch name is retained, and Merrill Lynch operates as a wholly owned subsidiary of Bank of America. So for performance, I'm going to touch on year-to-date first for 2018, and it's total return for each account, and total return defined as interest earned plus appreciation or less depreciation in any security value. And for United, January through July, it's 0%. For Third, it's negative 0.21%. And for Golden Rain, it's negative 0.24%. The indices for the same period, so the Barclays U.S. Treasury Intermediate Index, negative 0.89%. The Barclays U.S. Government Intermediate Index, negative 0.86%. And the Merrill Lynch U.S. Corporate Bond 1 to 5 year single A to triple A index, negative 0.27%. Long-term performance, I believe, is most important. So the average annual total return for each of the accounts are as follows. For United, which would be April of 1994 to July of 2018, the average annual return 4.64. For Third, same period, 4.59%. And for Golden Rain, January through 2004 through July of 2018, 3.12%. The fee is currently 0.26 of 1%, or 26 basis points. Accounts are aggregated for fee purposes. There are no additional transaction charges or any additional fees imposed by Merrill Lynch. Trades are executed at institutional pricing, and Blackrock has assumed fiduciary responsibility for decisions and timing. I'm just going to spend a few minutes on the presentation book and call your attention to just a few pages. There's dark blue, navy blue tabs, Roman numeral numbered, and behind Roman numeral 2 is the information for United. Behind Roman numeral 3 is for Third, and for Roman numeral 4 is the information for Golden Rain. The second page behind each of those tabs is an asset allocation overview, and it provides a breakdown of the securities, how much is in money market, and also the total portfolio size for each of the corporations. The third page behind the dark blue tabs is the fixed income analysis. And it provides a breakdown of the type of fixed income securities, whether it's treasuries, mortgages, or corporates. It'll also give average maturity information, duration, and the average yield to maturity on each of the portfolios. And the fifth page behind the dark blue tabs, that's performance review. So it provides the performance information that I've already stated, but does include a few more details. And I think of interest this year is just the positive performance on all three portfolios for the last 3 months relative to the full year. And I'm hoping Craig and Ed will touch on that a little bit. The last 12 months, and I don't know that it's on the screen, but maybe we can add that for later, Betty, but it's the behind Roman numeral number 1, the second page, and it's the historical U.S. Treasury yield curve. And it's just I find it an interesting chart this year. Thank you. The orange shows, the bottom line is orange, showing just where rates were last September, and above it, the dark blue showing where we were at the end of June. And we can see that the 10-year Treasury is up maybe 0.5 point in that time period, but the short term, the 3-month, is really up almost 90 basis points in the same period. And so the 10-year Treasury up, but the 3-month notes are really up. And my point is that it's flattening the yield curve. There's less difference between the rates for the two different maturities. And I know there's been some talk on the news about an inverted yield curve. I just think I'm going to let you touch on that, if that's going to have an impact on the portfolio at all. Merrill Lynch expects the year-end 10-year Treasury to be 3.25 by the end of the year, this year, and with 2 additional Federal Reserve rate increases in 2018 and 3 for 2019. And I think also, if we could touch on just the Treasury inflation protected notes, the securities, the TIPS, that would be helpful. And finally, any comments or recommendations for any changes or additions to the investment policies?
Okay. Well, good, thank you. Now, once again, Taryn stole their entire presentation, so we apologize.
I don't think so.
But this is actually a good chart to start with. If you take a look at this Treasury curve, and I'll give a little blend about the economy, kind of what our expectations are, dig into portfolio, and I'll use Craig here, who's currently looks like he's sitting in a baby seat to chime in, and he's got a lot of other good facts and figures for us. So, but the trend of this marketplace has clearly been a flatter yield curve. The Federal Reserve has been quite aggressive. We've had 2 rate rises this year. It looks like September is going to happen again, so you'll see another 0.25% move, and so your money market funds, items like that, will start taking the boost from that. I'm up in the air on a coin flip as far as December is concerned. My esteemed colleague Craig thinks, as maybe Bank of America Merrill Lynch does, think there may be 2. I think it's data dependent. I think as the year progresses, people are going to start realizing, maybe formally realizing, that maybe they didn't get the tax cut they were expecting to get. I think some people are going to be fooled to realize they really had a tax increase with the elimination of this, especially in blue states, New Jersey. I'm from, you folks are California, New York, Connecticut, Illinois, where you have a $10,000 basket to put your property taxes, your state and local income taxes. That's going to fill and overflow by the first quarter in many states. So I think it's going to have somewhat of an impact and a headwind on the overall economy. I think as people realize, wait a second, this is a tax increase, they're going to pull the reins back slightly. And now, you read articles about real estate. The Bay Area is an anomaly. That's unique up there. But even Southern Cal, stuff staying on the market a little bit longer, there's a little bit price pushback. I see it in New York. I see it in New Jersey. So if now your prized asset's no longer appreciating dramatically and perhaps rolling back somewhat, people take a step back and say, hey, maybe I'll be a little more conservative on consumer spending. Consumer spending still represents 2/3 of GDP growth. As far as this curve's concerned, there's not, and you'll see some of our recent investments, we'll get into details. Our bias has been, is allow the overall maturity and portfolio duration to shrink down somewhat. And even when we had cash sitting in the portfolio recently as the last couple of weeks, we had 5, 6, 7% cash, which was terrific. We're rolling in 2-year treasuries, getting at 260, 265. Why in our right mind would we go out and buy a 10-year at 285 to take 8 years additional maturity for 20 basis points of return? You wouldn't do it. So the yield capture on the front end in the kind of 0 to 3 year area is phenomenal. We would do the same thing in the corporate space. We'll do the same thing. The mortgages have average lives a little bit down. We're not putting a lot of money there, but we'll do it in the treasury space. And I know we got approval for government-sponsored enterprises a couple of years ago. We have not owned one since, and the reason why, they're basically on top of where Treasury security is trading. So if you get a Treasury security at 265, maybe I'm getting 269 on an agency. I don't see the value, even though they're kind of almost in the same basket of government securities. I don't want to have that they spin off and say, now you're a privatized organization. We don't see the value. So we've maxed out in the portfolios virtually our corporate exposure, and then really have eliminated any GSEs, government-sponsored enterprises. We have the flexibility if we want to incorporate it, and we certainly will if value re-enters the market, but for the moment, we don't see it. And the curve's going to get flatter. I don't believe it's going to be an inverted yield curve, but you certainly get flatter. I mean, you look at the differential. I think Taryn kind of highlighted it, but 2 years, less than a year ago, was at 148. We were probably here last August, probably in the 130s somewhere. Today it's 265. It's almost a 1.25% rise in 2-year yields, whereas the 10-year was at 233 last year, and it's 285 today. That's increased 0.5%. So a lot of value has been created in the front end of the yield curve. We like it. That's where we think we're being compensated, and especially mitigating risk dramatically. And you'll see, for at least the time being, our focus be on the front end of the yield curve and start dialing back some of the duration exposure. I think it's kind of played in how we, despite overall interest rates rising in this period, we were able to still deliver, kind of flat type performance, whereas the indices were down 0.75+%. And that's just because it's a duration scheme that they played there. So, that's kind of what kind of our thought process is. Federal Reserve moves, I think potentially a headwind from this. The economy looks great. Listen, unemployment's sub 4%. We all know there's a lot of geopolitical noise as far as trade wars are concerned, or are we friends with Iran or not friends with Iran today? Do we like North Korea today and not tomorrow? I mean, there's geopolitical risks that still exist out there. And the trade war, I don't know. I mean, I think a level playing field is the right thing to do. How we're getting there is a little bit odd, but perhaps if we do in fact get it, I would think if this thing plays out, assuming the president's not thrown out of office with all this other noise we've heard in the last couple of days, it looks like he's setting this thing up to have a trade resolution by sometime mid to late October. Perfect timing for midterm elections. He'll go out there and say, we've leveled the playing field on trade, we've done this, we've introduced tax reform, we have sub 4% unemployment, and look at all the millions of jobs we've created, and look where the equity markets have come since I've taken office. And so it's be tough to kind of fight the tide, and have kind of the loss of control of the Senate and the House in that environment. It almost seems like it's choreographed to play out that way. We'll wait and see. This thing could change on a dime. But, I think the overall health of the economy is okay. I think inflation's still relatively benign. We really haven't seen a lot of, what we look at, capacity utilization constraints. We look at wage inflation, and we're just starting to see a mild, at least ramp up, at least in the thoughts of pushing wage inflation up, but it hasn't accelerated. So inflation overall, I mean, some people argue, I go to the market or go, whatever, and it costs a little more to fill the basket up. When it's all kind of put in the sausage maker, comes out and they measure all the things that are deflationary, inflationary, inflation remains relatively benign for the moment, still under control. We're knocking the door, probably knocking the door at 2%. That's kind of what the Federal Reserve wanted, and we'll see what happens. So we think rates certainly have a mindset to migrate a little bit higher. Do we get to 3.25 by year end? I don't know in the 10-year. I think 3%'s realistic, and we could run to 3.25. Maybe next year's 3.5. But I think the way this portfolio is set, where we have a lot of short-term maturities here that are going to roll off and create additional cash flow for us, it gives us the ability to reinvest this at higher interest rates. That's what we've been waiting for years, it seems like. So that's kind of what we're excited, in fact, would happen here. Once again, corporates, they've actually, I think overall, since we introduced them, have been a benefit to the portfolio. I'd say in the last 6 months, or the first 6 months of the year, they're probably a little bit of a detractor just because, the yield on those kind of widened out a little bit, so they underperformed the treasury sector, but they've actually behaved nicely in the last 8 weeks and been an additive to the portfolio. So, overall, I think it's a great investment to have, having a 20% and 30% allocations. We're virtually there. We feel happy with that. We like the structure of the mortgage backs, like the structure of the treasuries, and I don't see us moving the needle of maturities and particular duration dramatically here in the relative near term. Craig, you want to jump in on some
I
things?
was just going to add on the tips,
Go ahead.
just to talk on it when you mention inflation.
Yeah.
Do you wanna
Yeah,
connect
I mean,
that?
Craig, I'm going to give Craig the dais on tips a little bit.
Sure. So we consider tips every time we're investing in treasuries. And so similar to the theme that Ed mentioned throughout his presentation, we like the front end of the curve. And so we're not seeing a tremendous amount of value on tips in the front end of the curve. And I don't want to take on the duration of a 10-year tip. And because we're not super concerned about inflationary pressures at this point, we just haven't seen the value to add to our existing tip allocation. Doesn't mean it's not under consideration every time we look for a trade in these portfolios. It just hasn't been the right timing. If we get to a point where we see more inflationary pressures or we feel more comfortable with duration, we certainly might expand upon our exposure. But at this point in time, I think we're pretty comfortable with what we have, and I don't really see us meaningfully increasing.
Yeah, we have. I mean, it's an available tool in our toolkit.
Yep.
We just don't see to use it now. We don't think it's prudent to incorporate in the portfolio. But you know, we could sit here, you know, and I could be sitting here in February next year saying, in September, October last year, we put a 10% allocation to tips if we felt that was
I think,
warranted.
yeah, I think if you look at inflation from a broad perspective, right, there's certain elements that are inflationary, right? Rent is obviously moving higher, certain goods are moving higher, but from a broad perspective, the service-based nature of the economy, right, the fact that we rely on Uber and Airbnb and all of these shared vehicles, it certainly depresses the inflationary pressures that we're used to seeing. And so I think that's why when everyone's expecting inflation to move higher because because unemployment rate is so low, you're not seeing that manifest in the data. And if CPI doesn't move higher, the value of the tip is kind of mitigated. And so that's another reason why we've been less inclined to increase our exposure.
Yes, Ed.
Question on the tips is, could you do a short-term tip, not just the 10-year tip?
Sure.
Basically, so that way that would hedge the bet against the, inflation and stuff like that?
Yeah, absolutely.
Okay.
And it's something we look at, right? So if we were to add tips, I would add it probably 1, 2, 3 years.
That's what I'm thinking. Okay.
Absolutely. Yeah, we're in agreement there.
Thank you.
Okay. Whitney, are we using our request to speak buttons or not when this is up?
They should be available.
Because I'm not getting them. Oh, okay. I don't think they're showing up on their screen. So at this point, we'll,
I see
okay.
something.
So did anyone else have, Al, I know you had a comment.
Well, I'm just curious, you're showing the securities investment, 19 million and
For which entity?
94,000.
Which portfolio?
You're not showing a market value. What is the market value?
Are you talking about GRF?
Yeah, Golden Rain Foundation.
All right.
I noticed on the Ginnie Maes, every one is, the par is way, we paid way over par.
That's the market value.
Right.
I'm looking at page 13 of 20.
Of the agenda, not of their book.
Oh, of the Ginnie,
Oh.
yeah.
This is
So
what
you-
we're looking at.
Oh, I know, well, I'm
The-
still asking this.
I think one of the differentiators on the Ginnie Maes, right? So the market value that you bought versus what you currently hold, people are paying down their mortgage, and so one is a lot higher than the other. And so when people pay down their mortgage, you're receiving more and more cash flow that we're reinvesting in other parts of the portfolio or back into Ginnie Maes if we see value there. So it comes down to prepayment speeds. In a low rate environment, you're going to get more back. If rates rise, you're going to get less back, and the differential will be a little bit
Rates
closer.
are rising.
What's that?
I'm just curious, because I'm just, how do we get the market value?
Well, the market value.
Because we're showing that at cost on our balance sheet. It's not on your schedule, it's on our schedule.
Oh, I'm sorry.
Should we wait till we go over our financials?
Of the regular finance
I
committee.
don't know, you want me to bring it up later?
Yeah, they're just reviewing the presentation materials that
Okay.
they've prepared in the spiral notebook.
I don't have that. It's
don't?
not, we're not involved in that. The tower.
For GRF, just for GRF.
But he didn't get a copy of this? I think there could, yeah, there we go. Did anybody else have a comment or a question? I had a comment on GRF. I think that we have, we have $1 million that's liquid, I think, and then we also have maybe $600,000 or something in some, the mortgage-backed securities that are, I think, is that what it was, that are going to mature soon? No, it's the
Yeah.
Yep.
whichever, yeah. So my question is, so what will you be putting those into?
Yeah,
Yeah,
it's a-
that million, I'll let Craig go. The $1 million, as I indicated there, we, like about a week ago, rates picked up a little bit. And what are we rolling into, Craig?
Bought 2-year treasuries across the board.
Yeah,
So we
so
bought
we-
2-year treasury at 265, August 3rd, August 4th.
And cash is down to probably 1% in most accounts.
Yeah. And
Oh, okay.
And I think moving forward, whereas in the past we pressed the accelerator down on the corporate exposure because we've seen a lot of value there, the fact that treasury rates have moved so high, we might increase our exposure to 1- and 2-year treasuries instead and let our corporate exposure dial back a little bit.
Okay,
Yeah, we'll just, if we get cash building account, we'll kind of take a look at where the market is and say, look, if we think we can buy it today at 255, or we believe it might be 265 or 270, in the near term either because of the factoring in of the next rate rise that's kind of built into the marketplace. And we'll go forward and grab that. I think on the one chart that, the yield curve chart, it had it at June 30th, the 2-year 253. So we were building cash through July, et cetera, and we waited and we're able to redeploy it at 265. So we picked up 12 basis points
Okay.
as a result. So there are times we'll build cash and we think it's the right place to be. But if anything, at least in foreseeable future, and that's, I'm saying in the next 6 months, I think the home's gonna be keeping in the very front end of the yield curve, kind of 2 years-ish area. Whether it's 18 months or 30 months, but somewhere in that space
Okay.
is we're gonna focus on in the near term.
Because it was some corporate bonds, the Home Depot and the,
Yeah,
the
and
bank.
if they mature, we'll see where, corporate spreads are, if we're, compelled in that space, we'll reinvest in corporates, or if we think the treasury offers better value, we'll just sit in treasuries for a while.
Okay,
To give you some context around the flattening of the yield curve, we can buy a 2-year corporate today at the same yield that we had to go out 5 years to get a year ago. So we have the ability to stay a lot shorter on the curve, take a lot less risk while still getting compensated with the same type of yield.
do you have any risk that the interest rate's going to go down?
I mean, there's always a risk it could go down. It could go down, anything that's a flight to quality driven. I don't think the economy has enough to kind of derail it at the moment. I think if you had an impeachment, you certainly see a flight to quality that drives rates down initially. I think if you go into some, geopolitical protracted issue with Iran and all that stuff, we're back in the ring fighting with Russia again. A geopolitical event that could drive interest rates down for sure. But nothing, I think we kind of we have been sitting in kind of a relatively tight range outside the 2-year area, that we kind of sit in that environment, maybe migrate up as Taryn indicated, maybe 3.25 by year end, the 10-year treasury. Not that we're invested there in your portfolio, but that if looked at as a benchmark treasury, I don't see a lot of reason that we're gonna go back, that will be at 2.5% necessarily right then and there.
Okay.
Absent a geopolitical event, we're still the best house in the bad block, so money pours in and there's trouble around the world.
Okay. The other question I had was just about the format, in that I looked at the one from last year and the one from 6 months ago, and it just seems like, last time I think was February, and I think we didn't get as much detail on the holdings, but we got more on like the account balance monthly.
Yeah, I
And
think
so
we-
I just didn't, I really like this detail, that maybe, it would be nice to at least see annually, maybe or maybe for the last couple of years, monthly or something, but I don't think we have much in terms of our account balances in this one.
As much this time.
Yeah, so are we purposely,
No,
Oh.
not purposely.
okay,
So,
okay.
it's the presentation before that you thought was,
No, I really like this, because I thought this gave us a lot more detail. And in fact, then that is my question for Betty, is can this, what we attach to our financial statements, isn't this much detail? It doesn't name, for example, the corporate bond. Is that something we want to do, or can we do?
Well, I think we have a holdings list behind every one, right?
She likes that.
Yeah, we're like this one, yeah.
Like we had some, and I think other times we had, because I look back over like the last 3 or 4 that I had. And so, for example, some of them had a total cost column and an unrealized
see,
gain or
yeah.
loss column, and that wasn't in
Oh,
here.
yeah,
And so
so
I thought that
Yeah.
might be an actual decision.
that was a decision.
Okay,
We removed that, we removed that because of certain accuracy issues this time
Okay.
around. So
Okay.
I don't know that that's necessarily coming back. If you need that, something that we can provide from Taryn. As the custodian, we like P&L to come from Merrill.
okay.
rather
they're
than-
amortizing the
They're
cost
amortizing the
properly.
cost basis, whereas we're looking at mark to market so that we can trade based on market value. We're obviously leveraging P&L on Taryn's side, and a lot of what we hold in the portfolio, we hold to maturity. But if we want to see P&L in positions, I think we like to leverage Merrill Lynch.
Yeah, most managers rely upon the custodian for
Okay.
that, and that, in this case, Bank of America Merrill Lynch.
So, are there any questions before I let them go?
On your side.
No? Okay. Pardon me? Is there anyone in the audience? I know we said we were waiting on members' comments, but that's for things that are not about this. So does anyone have a comment or a question for anybody here? Greg?
I I heard a lot of, when you did your presentation, Taryn, that there was negative long-term yields. Was that because of the interest rates that were very low initially, or the investments that we had? But everything seemed like it was negative 1 point, negative, and so on, which,
So
I think we're talking about the performance, Taryn?
yeah, the
Yeah.
performance, so that was the short term, the year-to-date, January 2018 through July of 2018. The longer-term performance, which I also gave, was not negative. So I gave the average annual rates of return for each of them.
Because United was flat, 0% for the first 7
Yes,
months.
so the,
And other ones are off.
correct.
I guess from an academic standpoint, we're looking at an economy that's flourishing, everything
Right.
going crazy, and yet our short-term gains are negative. And I'm kind of wondering how that's happening.
So the performance is interest that's earned, plus any appreciation in price or less any depreciation in price. And so simply, and I'll let Craig or Ed tag on, but we've been in this calendar year, January through July, in an environment where interest rates have gone up
Right.
and bond prices have gone down.
Down.
And so for the period January through July, for United, for example, it's flat because you did earn interest, but the bonds went down in price.
Okay.
Now, does it mean that you've lost
Oh, no, I understand
period?
we haven't
Yeah,
lost capital.
but for this period of time, that total return number that we're reporting, which is those two things combined, interest earned plus appreciation or less depreciation, resulted in either a flat or a negative, as did the indices. They were also negative.
And they were.
Then the
negative by a
longer-term
larger
performance, which for United was 4.64 average annual rate of return since inception.
Okay, so I'm assuming that based on these numbers now, we're considering perhaps mixing it up again, maybe less bonds or more treasuries? Or-
No, I mean,
Or are we just writing it out?
We're gonna be all fixed income. It's just gonna be clearly, instead of, when we have a maturity, we have cash available. So instead of saying we're gonna buy a 5-year bond, we're gonna look at the 1 and 2-year-ish area. And we think the best value at the moment is treasuries versus corporates, government-sponsored enterprises, or mortgages. So, you'll see trades coming through over the next couple of months until we find valuation re-enters and creeps back into the corporate market. Still in the fixed income arena, but it'd be primarily treasuries, I think, initially. And on the very short end, if you're being paid $265 for the highest quality credit you can procure, I think it's a pretty good place to park for a while. And it was just, the portfolio we designed here with the shorter maturity duration was less impacted by the rate move, by the evidence, how we did versus the index, but you just couldn't escape it, just because rates have moved. You saw that the 2-year year ago was 140-something, 265 today. It beat it up pretty good. So if we haven't, we're not forecasting another move like that in the next 12 months. Maybe we'll go up another 0.25% in the next 6 to 12 months. And so you'll start seeing positive returns re-enter the market.
I would assume anything long-term in this economy would be not advised or ill-advised. I would stay with a couple of years because it's such volatility.
Yeah,
To make a
exactly.
10-year commitment based on what's happening now.
Yeah, and you're not being paid for it. So for us to buy a 10-year bond at 285, and we get a 265 a 2-year,
Not
where's the
worth the
trade?
risk.
It's not worth the risk.
Yeah.
Yeah, there's not worth the risk.
Agree.
It's silly. So,
Okay, thank you.
you're welcome.
Okay, so if there are no other comments or questions, then I will thank Ed and Craig and Taryn and dismiss them. And I'll take a couple of minutes, we'll have a little recess, but we are still taping, so if you all could just come back in a couple minutes, that'd be perfect. Just allow them to go. We're going to switch
Who wants
place
to
load.
see?
I don't think so.